Okay, in this last chapter, what we want to finally do is we actually want to return back to a topic we had talked about much earlier, and that's actually to talk about the international economy. And in this case here, we're just going to give a kind of an outline of the way in which international trade and international exchange basically changes a country's trade deficit with one another, something you've probably heard about in the news in the past, and talk about how that then impacts a country's foreign currency. Okay, so here we're going to be basically now talking about an open economy. An open economy basically means then that it interacts with other countries, engages in trade with those countries, and we basically collect that data on an annual basis, something that's called the balance of payments. The balance of payments has three accounts. It's a current account, a financial account, and a capital account. And within each of these three accounts, there are both debits and credits, kind of like in an accounting sense. The debits, basically that would mean that it's a transaction where a country's currency is being supplied to the foreign exchange market. So that would mean, like if we were talking about China's balance of payments, that would be any transactions where the Chinese are supplying the yuan to the foreign exchange market. The credits would be where there's a demand created for the country's currency. So the credit would, in this case be us buying something from the Chinese, that would create a demand for Chinese yuan because Chinese aren't going to want the dollar, they want their own currency, the yuan. Okay. So within the current account, we're talking about the purchase and sales of goods and services. And in the capital account, we're talking about the purchase and sale of assets. And then finally, in the financial account, we're basically looking at assets that are purchased abroad, and the foreign purchase of assets by a country. These are like official measures here. So this would be if the government was buying something. It's also helping us capture then, basically the official ways in which there's capital inflows and outflows. Now, the exchange rate for any country's currency is basically going to be the country's currency as measured by the price of another currency. The balance of payments overall must equal zero. That would mean that the capital account and the current account, if one of them has a debit, the other one must have an equal valued credit. They must balance out from one another. That balance of payments is going to affect the exchange rate. Okay, so what we see here is the market for dollars and pesos. We have the exchange rate, which is dollar per peso, so how many dollars it takes to buy a peso, and then the quantity of pesos. Here, and this is an important difference, we're looking at pesos for a dollar. How many pesos does it take to buy a dollar? 10 versus 0.1. Makes sense, right? A peso should cost 10 cents, or it would take 10 pesos to equal $1. Then you would have quantity of dollars down here. What is the supply curve in this graph here is the demand curve here. What is the demand curve here is the supply curve here. And basically then you would have, why would you ever demand a US dollar? In this case it would be Mexicans needing US goods. Why would there ever be a demand for the Mexican peso? That would mean there would be a demand for Mexican goods. Where does that, basically those Mexican pesos come from? Well, that's linked to the fact that Americans have dollars and they're going to supply those dollars to get the peso. Over here, we have the Mexicans wanting American goods, so they demand the US dollar to buy American goods, and they trade for it the pesos that they own. Now, when the country's currency is gaining value relative to another, it's appreciating. When it's losing value relative to the other, it is depreciating. That would essentially mean moving up and down in terms of the equilibrium value. And we would imagine that we'd settle on the equilibrium, where there's neither a surplus nor a shortage. right? And if we look at what then affects the exchange rate's equilibrium rate overall, that would be things like what are the income growth rates? How badly, how badly does someone want something based on their income levels? What are the inflation rates? Is it the case that if the U.S. had very high inflation, why would you buy American goods, right? So then what other currencies would we buy goods from, right? And then finally, changes in the real interest rates. This is important because it's going to affect where investors invest their money. Would they invest it in the U.S. dollar if the interest rates were really low? Probably not, if there was another equally safe country where the interest rate was higher. Okay, and then when we look at what affects the demand and supply curves for those in that foreign exchange market that we described up here, right, what's affecting demand and supply, what's determining it? Well, the largest part is just going to be how badly do you want the goods produced in that country, right? How badly do you want to invest in that country? And there's a little bit of an extent to which you try to speculate and you try to get more value based on your ability to predict that you can make a profit off of owning the currency or not. Now, there are going to be times where the value of the currency is going to be fixed. And if it's fixed, then what you would see here is a fixed exchange rate where the currency is going to have to intervene. Otherwise, it's done by the market. Okay, I'm going to stop the recording here and then pick it up.